And welcome everybody to another edition of the Property Management Mastermind Weekly Update with my co-host Matt Whitaker. And we
That's the
are
first time
in,
you called me that. I appreciate that, Brad.
well,
I
it
didn't.
was
I've
your
been
idea.
waiting on that. I mean, I'm going to change my Facebook status now.
It was your idea,
Oh,
okay? And so
okay.
here I am in
You're
Ice
stuck
Station
with me.
Zebra in the underground bunker with the dog in the background. And we have Kevin Jones on today, the founder of Simple Bills, who was recently acquired by RealPage. And we're going to be talking today about utility providers. I don't think there's anybody else better equipped to talk about this than this guy. He's a business owner. He understands utilities in, out, and backwards. Matt, how are you today? Kevin, how are you today? What's going on?
I am great. I'm excited. We're going to talk to Kevin, obviously, and understand what he does. And then we're going to talk more about the PPP loan, how to make sure it gets forgiven. I've got a huge email that I got from my accountant that I'm going to share what will be some best practices. So, Kevin, tell us who you are and tell us about the business that you run at now RealPage. It used to be your business, but then you got acquired.
Yeah, well, thanks so much, Brad and Matt, for letting me join the call today. Very excited to share some of the insights that we've seen over the past couple of weeks, month or so with utility providers due to COVID. So my co-founder and I started Simple Bills a little over 11 years ago, and we were acquired this past July in 2019. Um, at a high level, Simple Bills really was created based out of a need of figuring out how to simplify utilities, because so many times utilities are messy, and the best equation that I can put utilities to is basically a big ball of spaghetti that's really messy. There's a lot of intricacies about utilities that is not always easily understood. And our goal of making our company was to simplify them at the highest level. But yeah, so we ran the company for about 10 years, and then we decided that we wanted to take the company to the next level, and we really thought that would be best with a strategic partner like RealPage. And man, it has been an incredible experience since the acquisition. It's really launched us into the single family space. Although our roots are actually in the single family space, we've had a lot of focus in the student housing market for a long time, and that was kind of our claim to fame. But the single family space has been really exploding for us just because of the need that we're meeting from a utility perspective.
Let's talk about that need. Tell me exactly what Simple Bills does, the problem that it solves.
Yeah, so at a high level with Simple Bills, the biggest difference we bring to the table is whenever we're implemented with the PMC, all of the utilities remain in the PMC's name. So for the tenant, they're not having to set up, pay deposits, pay setup fees for each utility provider upon move-in. And then on a monthly basis, we are going in as Simple Bills as a third party, retrieving those utility bills, invoicing the resident once a month for all their utilities, collecting from the residents, and then paying the utilities as they come due. For the owner operator, the PMC, during that turn time when utilities are having to fall back in your name to do your make readies, all of that really goes away from a logistic standpoint of having to transfer the utilities back and forth, and those deposits and or setup fees go away because utilities are always on. So
talk to me a little bit about, I mean, as a potential buyer of this product, my biggest fear is I'm going to get caught stuck with the bill from the resident. Obviously, that's probably number one you hear pushback.
Sure.
How do I make sure I don't get caught with the bill from the resident?
Well, I promise you, we wouldn't be in business today or so successful.
I figured you
we
wouldn't.
didn't
I
know
mean,
we
it
knew how to
doesn't make
collect,
sense, right? I mean,
Yeah.
RealPage thought this was a good idea.
Sure. Yeah, utilities have been done the same way for 20, 25 years, and specifically in the multifamily market. And they've tried to bring that to the single family market. But what we've done is really kind of change the game a little bit with our approach. And the bill and collect model that we bring to the table is definitely unique. It's a very proactive reminder process that escalates from emails, text messages, even phone calls to the resident. I would have to throw you into our UI to get an experience on what the resident has, from access to information, transparency, and just the data from month in, month out, and how they compare even to similar homes in the area. We do a lot of effort with providing data and transparency that allows us to the customer understand what their utilities are, and then also how to pay them. And ultimately, we do have a model where we have a card or bank account on file for the customer. I know we're kind of getting a little weeds here, but we utilize that as more or less a backup for payment. But our default rates are pretty low. It's usually slightly lower than what you're experiencing on rent defaults for a particular market, but across the country we're seeing defaults 2% or so.
And so what does that cost me? Does it cost the PMC company something, or does it cost the resident something?
So we do charge a monthly service fee to the resident, and that's where we make our revenue.
Cool.
So, yeah.
Okay. Very
so
good.
RentWorks is taking a look at this, and we bought into it. We're implementing it now, but the COVID thing came up, which is why I wanted you on, KJ, because RealPage and your team has compiled a list of providers that is a really good resource. And so we're going to be posting a link to this in our show notes, so everyone can go there. But it's basically it's a RealPage. You can talk about it. So give me what you found out and how this is going to benefit PMs.
So outside of Simple Bills, what any PMC is dealing with today is with tenants and what the tenants are managing to with their utilities and what they're experiencing. And so we've created a resource for any and everyone. Brad will post this for everyone, but it's basically a list of almost 4,000 utility providers that we manage to within our system, within RealPage and Simple Bills. And within that file, we provide, is the utility provider disconnecting service and or charging late fees when there is a non-payment or delayed of payment, and then when that is affected, how long will they allow this to go on for? Is this for the next 30 days or is this basically indefinitely? What we're finding for the most part is most providers, if you can show proof of financial hardship, they're giving you grace. There's removal of late fees or delayed of turn off, and that's for all utilities: electricity, water, gas, cable, internet. So they're really trying to help those who are affected. It's not to say that the customers won't owe those fees in the long run, but they're trying to help out where they can. The providers are doing that, and so are the public utility commissions are even stepping in. For example, Texas, the PUC actually came in and said, hey, for the next 6 months, we're not going to allow electricity or water turnoffs. You have to give the customer grace period here during this extreme environment that we're in. So it's not only providers, but also the regulatory support system behind those providers as well.
So one urban legend I want you to kind of talk about, either dismiss or confirm it, is that some of these utility providers were not turning on utilities for new tenants because they just didn't have the personnel to do it. Is this something that you've heard before?
We are seeing delays in turn-ons, for example, I was just reading up on a gas provider in Texas. 95% of their employees are working from home, which everyone's working from home right now. But usually municipalities or providers are really not suited for working from home. You're talking about a government entity or a state-owned entity that might not necessarily have the resources for allow you to work from home. So the onboarding or the turn-on process seems to be a little delayed. Now we're reading a lot about how all of these companies are taking extra precautions to turn on, to the extent of, providers would usually give you like a time frame, 8 to 12 will be there to turn on your gas, right? But now they have to have a specific time, and someone has to be there to let them in the door. There's social distancing measures communicated before they show up to turn on the provider. Now we're getting in the weeds here, but they're going to the extreme to prevent human interaction, but at the same time, acknowledgement that someone's being at the home. Usually you could give a provider a lockbox number to let them in the home. They're not letting you do that anymore. They want someone there.
The benefit we found that we really attracted us is when you turn, I want to make clear, everyone understands this, when you turn the utilities on, they never turn off, right?
Under the simplest model, right. Yeah, under the simplest model, it never turns off. But what people are dealing with today without Simple Bills are these issues, right? And so, before you reach out to the provider to turn on, check out their response on COVID. Every single website I've gone to, there's a COVID response section that leads you to a web page that tells you detailed. Response times have been delayed, call wait times have been absurd, just because the resources, I don't believe, are completely there. So from the turn on perspective, we're seeing delays. So that's kind of what we're experiencing.
Yeah, that's pretty awesome stuff. It sounds like a really cool service. And you and I talked before this, we're going to hook up, and I'd love to kind of hear we're in 8 different markets, hear how many of those utility providers you can help. You mentioned all this Texas stuff. Nobody cares about Texas. The rest of the country is what everybody cares about.
Sure.
So what we're going to do, and KJ, you're welcome to stay on the call if you want to bail out from here. But Matt and I are going to transition and talk about the payment protection loan program, the PPP program. I butchered it in the pre-show as well. You're a former business owner, so you have a lot to add. And I want you to throw out that tidbit you heard today, because that kind of floored both Matt and I. So repeat what you were talking about there earlier.
Yeah, so the SBA, the Small Business Administration, has loaned out more money in the last 14 days than the last 14 years. When I read that,
incredible number.
It's an incredible number. I was blown away by that number. And they even run out of money, which I believe we all know, or if you haven't found out, now you know. Now, it'll be interesting to see what happens going forward, but the fact that they were able to accomplish that, for one thing, over the last 14 days is incredible.
Yeah,
Kevin, give us the site on where they can go get this information about the utility providers real quick. If you can dump that, and then we're going to have it in the show notes.
Sure. So it is hosted on the Simple Bills website. We'll put it in the show notes, but it's simples.com/status-utility-providers.
Okay. A little tougher to say. Yeah.
Go to the show notes.
Go to show notes.
Yeah. Show notes will be in there. KJ, appreciate you having us.
Thank you guys so much for having me. Looking forward to talking to y'all soon. Best of luck to everyone. Really wish everyone well and safety. Take care.
Thanks, KJ. We'll be in touch.
Bye-bye.
So, Brad, I do think it's interesting. Just like KJ said, $349 billion has now been given out and or committed. I mean, my wife got her money today. So there's people that are just now finally getting their money, but as you know, they committed that money, days ago. And 349 billion has all been essentially committed to small business owners like you and me. You said you'd received your money. I've received my money. So let's talk about what we think best practices are going forward.
Yeah, I mean, it's almost like a case of Darwinism here going on. It seems like the biggest businesses and some of the other things are going to be coming out on this. And it's, you look at the big banks, and obviously they're going to prioritize to give the loans to their biggest customers. So that's what I mean by that. They're going to take care of the big guys, and the little guys are kind of meant to fend for themselves. And that money went quick. I mean,
yeah,
a lot of that, when we interviewed Mr. Sanborn, remember, from Seacoast, not his fault, but he was like, we project 5 or 6 weeks. What did it last? Week and a half?
Yeah, it was basically, actually it would have been 2 weeks today. So they ran out yesterday. So just under 2 weeks. So just incredible. So we get our money. Let's talk about best practices, what we feel like people should be doing. And my first thing is, we talked earlier today, is we both agreed that probably putting this money into a separate account makes a lot of sense.
And we really did that already, and I think that's very easy for people to do. I was talking to Trent Ratliff earlier today, and he was lucky enough to get a loan as well. And all that came through, and he's like, should I set up a separate account? I'm like, absolutely set up a separate account, because what's going to happen is when you can spend everything out of that account, you can do a quick QuickBooks dump straight out of that account and turn that back into your bank. Because keep in mind, you still have to show how much of what you spend to get 100% forgiveness. Matt, go ahead.
Yeah, so one of the things my accountant said, which has to do with this, is he said don't pay it directly out of that account. He thinks you don't have to set it up. You can commingle them. It's just going to make it way harder. But to account for everything that was done, and you certainly can do that. But if you set up a separate account, what you're going to do is transfer exactly the same amount of money into your operating account, the money you pay your internal bills with, that is in conjunction with the line item that it goes with. So if it's mortgage interest, then you're going to transfer money just for mortgage interest. He even said maybe write 2 checks for mortgage interest, just so you can make this almost dummy proof. Because what's going to happen on the backside of this, the bank you borrow the money from is going to be the one that's going to have to forgive the loan. The SBA truly didn't give all this money out. They basically said, banks, we don't have the ability, we haven't given this money out in 14 years. We don't have the ability to give it out in 14 days. But you're going to be in charge of forgiving these loans. So one of the things we want to do is make it as easy as possible for these banks to forgive. And if you're writing checks in the same amount, then it makes sense to the banker. And so that's,
you may not have enough time. Here's why you want to do that, because when you set up a new account, you can do that electronically almost within a day, half a day. But how long does it take to get checks? It might take 6 days, 10 days. That's why Matt's talking about transfer the money dollar for dollar, penny for penny, from that new account, PPP account, over to your operating account, because you already have the checks, you already have the ACHs going on. I mean, that's what he's talking about. So that seems redundant, but man, you're spot on, because now it creates that paper trail, and your CPA loves checks, right? Checks they all love, because it creates another image of something going in, something going out. They really do like those paper checks, so it's amazing.
Yeah, and the banks on the backside of this are going to have, if you thought getting the loan was tough, getting it forgiven is going to be probably as tough or tougher. So you want to make it almost like a rubber stamp forgiveness process. They're going to have 60 days after this 8 weeks to essentially forgive it. So, we're going to go through this 8 weeks, then we're going to give them essentially the information, and then they're going to have 60 days to forgive it. So my expectation is we're going to be waiting with bated breath to see, did we do everything right? And they're going to be trying to figure out on the back end what the heck's going on.
Because a lot of us are going to have the same question: is how exactly do we spend this money? Okay, yeah. The simple thing is over payroll. But, what if your payroll decreases? What if it is increased? I mean, there's all these what ifs. During the time frame of, a month ago, I laid off a few folks, but we made decisions to not necessarily bring them back right away. So now we have to potentially rehire. Okay, so there's some rehiring going on where we may not bring those exact personnel back, but I think we need to get creative. What are your thoughts?
Yeah, I totally agree. I mean, there is a calculation. I was just looking for it in terms of full-time equivalent employees that my accountant told us. But basically he said there is an exemption for rehires. If a borrower has a reduction in its full-time equivalent employees or employees' wages between February 15th and April 26th, and subsequently eliminates the reductions before 6/30, the forgiveness will not be reduced. So you can actually rehire people, it looks like before June, and as long as you spend 75% of your money still on payroll, then you're going to be okay in terms of that full-time equivalent employee.
Yeah, a great example was, we eliminated some fluff from RentWorks, and one of it was a professional full-time photographer. I mean, we lease out 450 homes a year. And so we did the math, and we figured it was smart, and it was, to bring a professional full-time photographer onto the payroll. Well, when things got weird, nobody's renting houses, nobody's signing up. I mean, there was nothing for that person to do. So it was a true layoff from inactivity. It wasn't anything they did wrong. It was just a layoff.
Yeah. Some other things I think people need to remember is you're not allowed to count payroll over 100,000 if somebody makes over 100,000 bucks. So when you're transferring this money and somebody makes, in excess of $100,000, you're only going to transfer the amount that would cover that 100,000. You also you need to spend it on 75% or more of payroll. You can also spend this on lease agreements, utilities, but you had to enter into those lease agreements or utility agreements prior to February 15th. And then of course, mortgage interest. Again, I get back to the fact that my accountant said, send a check for interest, send a check for principal. Let's make this thing as easy as possible.
So the mortgage, though, is obviously for your commercial space. Am I correct?
Correct. Yeah.
Yeah, because people don't misunderstand that. That's not for your personal home.
Right.
Okay.
Right.
This is for if you purchase commercial space and you have a commercial loan, he's saying that the interest is taxed. Basically, it's forgivable, right? That's how. And go ahead.
Yeah, one of the things that is interesting is are we going cash basis or accrual basis? In other words, like we signed up signed our loan documents a week ago today, and we also had payroll a week ago today. Well, I emailed my banker and he said, essentially the language conflicts. Part of the language acts like it's accrual basis, part of it acts like it's cash basis. But what my CPA is saying is he thinks we should just go with whatever the bank wants it to be. So I asked my accountant, do you want me to go cash basis or accrual basis? And he said, hey, let's do accrual basis. So we haven't even started drawing down the money on that, even though now we're a week into it. But we're basically burning that money now, and we can start charging that accrual basis when we sign the documents. Not when we got the money, but your 8 weeks starts when you first sign those documents.
That was one of my first questions, like when does the ticker start? So you said that loan document signing, that's when the clock starts for you on the
Correct
system. Okay.
Correct.
So we go 8 weeks for you from Monday. So 8 weeks from Monday.
For me, it was last Friday, but yeah.
Last Friday.
Monday is
So
when I got my money.
Okay, got it. So then you have a 60-day period to get that forgiveness. Am I correct?
Yeah, you exactly 8 weeks. So it's a little less than 60 days. You should, we do payroll every 2 weeks. We should have 4 payrolls, whether I did cash basis or accrual basis. I'm still going to have four payrolls. Now I'm going to have to prorate a piece of the front end payroll and the back end payroll to make sure it all works out. But everybody should essentially have 8 weeks of payroll.
So to be clear too, the 75% is kind of the target you're shooting for. Am I correct?
Yeah, and I wouldn't cut it close. I mean, you don't want to miss these targets. I would put it in there and try to make sure you're in excess in case you screw some number up or some formula up in Excel. And I would also keep a running tab in Excel. I think having this, having a dashboard that basically, this is free money if you account for it correctly. So having a dashboard that basically is a burn down of what 75% of your loan is just makes a lot of sense to me. And also keeping documentation, keeping all your tax documents, keeping your payroll documents, keeping your mortgage interest documents, keeping rent document, anything that you can justify, you want to make sure that it is in a nice, neat, tidy package for you to hand to your banker, because I'm telling you, the forgiveness piece of this is going to be every bit as frustrating as getting the money, and you're going to want to make it easy on your banker to forgive it for you.
Yeah, because we don't know how bad it's going to get. And who knows if they change the rules. There's always concern in my head that SBA is going to say, well, that thing we did, 8 weeks ago, we're going to go ahead and change that. We're going to do something different. And business owners might get stuck. So we certainly hope that's not the case, but let's follow the rules. So to be clear, let's talk about just one more time some of the expenses that we can get to inside of that 75% to get to that potential forgiveness range. So we talked about payroll. That's pretty easy. And interesting, I may have told you this earlier, but the way our payroll provider switched it up on us is normally they would just take the money from our account. And now, because of insolvency fears for every management company or every company out there, not just management companies, we have to wire funds directly to the PEO provider, and then they distribute out to our employees. Yeah. So they did a 180 on us. Like before, they're just pulling it nice and easy, set and forget. And now they're like, we demand a wire by Wednesday, close the business, or your employees aren't going to get paid. So we have to initiate a wire straight to them. Yeah,
which makes sense. They don't want to get holding the bag because that PEO group is essentially employing your team, and they have to pay them. And if you don't send them the money, then they're not gonna be able to pay them. So let's talk about what payroll costs. It includes health benefits, retirement benefits, and state and local payroll taxes. It does not include federal taxes. So that's another reason you wouldn't want to deduct the money straight out of this account that you're setting up for this, is because that would also include your federal taxes. So you're going to have to pay for those separately. So keep in mind, payroll includes health benefits, retirement benefits, and state and local payroll taxes.
That should be clarified. And I think that's huge. So people are going to have to do their own cost segregation, to where they break down every dollar they spend, that whatever's in federal taxes out of that dollar for us, for PEO, that we have to make sure we don't account for that. We don't want to sit at 75% and the feds come back and say, wait, this part of the federal taxes that you paid to the payroll provider, that doesn't count. You only spent 70%. Surprise, the whole thing is going to be, you have to pay back the whole thing.
Yeah. And I think that's a real possibility. Anytime you deal with the federal government, it's black and white. Like, people that work for the federal government do not see, different shades of gray. They just see it either is or it isn't, and it needs to fit in my box. And if it doesn't, so you need to make sure this thing fits in their box and make it easy for them. anything else? Keep in mind any rent, all of these lease agreements, utility agreements, everything had to be in place before February 15th. So it's not like you can just go out and rent a really cool space and pay a bunch of money for it. So make sure you're doing that. The other thing that I think we could talk about too is if you missed your payroll loan, don't fret yet, because it appears that that Congress is trying to get another $250 billion put towards this campaign. What would you say to somebody? Let's say that they do fund that $250 billion. You know, I'm talking to a lot of people that don't have relationships at banks. I mean, I had the benefit, like my bank didn't want me to default because I have loans with them. And so they had a vested interest in making sure I got this money. But a lot of people, you know, may run a debt-free, not-for-profit or a debt-free business, like management business. What should they do? I mean, get in there, some of these small banks, and start building relationships now?
I totally think that's spot on, because what happens is if you go to the big ones, the BFAs, the Chases, the Wells Fargo, and they look at you like you're a small business less than 100 million a year, they're saying get in line with everybody else, because it really is a pyramid, and it's a very big base to that pyramid where it goes straight up. So definitely want to start, you know, funny thing, I talked to Trent Ratliff today over in Atlanta. He got his funds. He went to a college roommate of his who runs a bank in South Georgia somewhere. And that's the relationship he went with. He didn't go to the B of A. You know, he didn't go to the big bank and beg them for money. He went to so you're spot on with the point of develop those relationships with the smaller banks and understand the banking model, because they want to keep you potentially on their happy list.
Yeah.
And, you know, that's going to, you know, affect when you start going to look for homes to purchase. You know, another conversation that everyone's been having is, okay, what opportunities does this create, you know, the business owner? And there might be opportunities to buy some of these assets. You know, look at the homes that you manage. If any of these sellers start to get into a hurt situation, maybe there's a possibility for you to acquire that home. Get creative, use wraps, use owner financing, you know, use things to acquire those homes, because this should be setting you up to where we can potentially become a debt-free, cash flow positive business if you can get these loans. And so consider that it's not just about covering your payroll, which we all want to do, and we want to rehire, we want to grow. Take this opportunity to expand. Take this opportunity to look at different methods of building up your business, because it's going to pay dividends and allow you to hire more people, right? Don't look at it like it's self-serving. Look at it like you can build this up to create opportunities for other people that are on your team. That's always the good way to look at it.
Yeah. And the other thing I think, and I mentioned this in an earlier episode, is if you rent your building, now may be the time to buy it. I mean, there's the commercial real estate industry is kind of throwing their hands up and freaking out right now. And maybe they need to liquidate something fast just to create cash. And you can do that. And going back to these small banking relationships, that's the type of stuff they really want to do. They want to, number one, they want to have our property management trust funds. They love those big cash deposits. Number two, they absolutely love to finance real estate, because it's easy for them to finance. This is another program, maybe an SBA program, that you can go buy your own office, and the SBA will actually help the bank fund that. In other words, they'll protect the bank up to 75% through a loan called a 7A loan. So get creative. Let's make this. I keep telling my team, let's thrive, not just survive. I mean, certainly surviving is a piece of this, but we've got to make sure that we're thriving after all this is said and done. We're in a great business. I mean, short of being in the food business, not owning a restaurant, but in the grocery store business, houses is the next thing people are going to need. It's not like our businesses are going to go away. And so I'm super bullish on all of our opportunity. Now, look, we're going to have to go through some crap. You mentioned people going through potential foreclosures. All of us that lived through the 08, 09, 2010 stuff, all of our clients were losing houses. And that's not going to be fun. But I'm telling you, at the end of this, there's going to be a lot of opportunities for us to raise the tide of our management companies. We're going to be able to grow organically. I think the sales market's going to slow down. So it's a good time to be in the property management business.
Yeah. Here's what else is going on. We talked about this maybe earlier, but the banks are telling the investors that have investment properties, they're not being real friendly on any sort of forbearance or forgiveness of any of this stuff. And so that's again going to be bank specific, but they look at you like you're an investment property. It's not your primary residence. Nobody's going to care if some landlord gets foreclosed on, which is putting them in a tough position.
Yeah.
So it might be an opportunity for a PM to step in and acquire them or help them out. You're doing them a favor, but then you're also keeping the tenant in the home. Because what happens if they get foreclosed on?
Yeah.
The tenant's put in jeopardy. Some primary resident might come in and kick them out, right? We saw this happen during the whole foreclosure process and throughout is if an owner gets foreclosed upon, it goes into the chopping blocks, it's sold, a new owner comes in, the new owner says, you know what, I'm moving in, I want you out, Mr. Tenant. So this is another way to protect your tenant base. So consider that as a big possibility that you can help an owner with what you need to be doing with buying potentially more assets.
I think what you're saying matches up perfectly. I'm reading again for the probably fourth or fifth time, Ray Dalio's book, Principles. And one of the things he says about successful people is that they're radically open-minded. And right now, if we're narrow focused on, property management, then we're not going to be able to reach back and see all of the opportunities that are going to come our way as a result of being in the property management business. It's a great platform and we're going to grow our property management businesses. But what are all the other things that we can possibly do? Help an owner who's getting foreclosed on, buy that house, keep the tenant in the house. Like we're in a perfect platform to help a lot of people. And when you help people, then you get paid to do that. And so, man, I am very excited. Listen, I am not saying that COVID-19 is a great thing because I know that people are getting sick and people are dying, but I'm also excited about the opportunities to help people and create value and then create opportunity for us as business owners that this is going to create for me and for you, as long as we're radically open-minded.
It's been virtually recession-proof. There's, a couple notes on that on some of the groups, how it's virtually recession-proof. And I got to say, I believe that wholeheartedly because if the market goes down, we go up. If the market goes up, we potentially go up as well with it because of the expansion. Here's the scary thing. So scary good, scary bad, whatever you want to call it. We saw today, there was an article that Chase, one of the bigger banks, is starting to limit the amounts of loans they're going to give out as far as primary residential buyers having to come to the table with 20% and have a 700 plus FICO score. So the trend is that if a lot of banks start doing this, basically in a nutshell, they're tightening their lending. If they tighten lending to primary residential buyers, you're going to see a lot more sellers say, I'm not going to sell at this point, I'm going to rent. Because the number of renters is not shrinking, it's growing.
It is.
The demand for single family homes is growing. People want single family homes more than they want multifamily. You're going to see multifamily in this recession get absolutely spanked. They're going to get killed. And single family is going to do very well. If nothing, at the worst thing the single family homes do is they just maintain. That's the worst thing they'll do. I predict they're going to go up in value. They're going to go up in desirability. They're just going to do nothing but good things, especially again, back to where if the lenders tighten up. And man, you talk about freaking out some industry there, the real estate industry, as far as real estate sales, they're going to be freaking out and they're going to be invading the property management space, wanting to take over. So you're going to see some interesting times come in. Yeah, we're back. The good times are gone because, real estate agents love to pop those $15,000 commissions. That's what they live for. They don't want the $15 a month that we make in property management. They want those big commissions because they think they're rock stars, right? And so, we live on pennies, the management companies. We live on pennies and nickels in aggregate.
Yep.
And the real estate agents, their mindset is to pop that big 10, 15K commission and go on a cruise. So it's going to be an interesting time coming up the next few months.
Yeah, this is it is going to be interesting. Just to kind of update on my collections, we're only about 2% down month to date, month over month last month. The only thing that's hurting us right now in terms of just numbers month over month is management agreements. We're not signing nearly as many management agreements. Maybe we're down about 40% on those. So but it kind of makes sense, right? If I own a house, I'm trying to figure out what in the world's going on, right? This is kind of the the initial punch in the gut. I think as the government starts to give some clarity, whether it's governors or Donald Trump, they're going to give some clarity on when this thing's going to reopen. I think we're going to get an influx of new leads from potential property management agreements.
It's an accordion effect. It really is. We're shrinking it now. We're kind of in the same boat at RentWorks. We've had down numbers the last 60 days, 45 days, 45 roughly. But we expect that to be like a faucet. I mean, really, I don't know when, I don't know what there's not going to be a date, as far as a calendar date. But at some point, we're going to look back and say, holy cow, we signed up that many last month.
Yeah.
That's what it's going to be like, because it won't smack you in the face. The biz dev people will be running around with their hair on fire, but they're going to love it because it's going to be an opportunity. And again, with the minimal turnover, meaning that the turnover of tenants not leaving their homes because of instability, they just don't really know what's going on.
Right.
They're not leaving their homes, which means owners don't need to hire new managers. So less turnover, less flux means less business potential possibilities for new management. But I think it's going to be like a faucet, man. They're going to turn it on, and we're going to see that ratchet up pretty quick.
Well, when homes don't sell this summer, then they're going to go to rentals, right? Just like during the recession, I remember every year around July or August, they'd try to sell their home, and then all of a sudden they're back. And we're clients that are leaving are probably also going to put their house on the market because they're like, this is it. There's a coming recession, and then they don't sell it over the summer. They might go back to renting. So
essentially nobody's relocating. Whether you're military, whether you're civilian, and you're working in, for whomever, the corporate world, they're not relocating. They're not moving. Nobody's moving right now. Yeah. So when that starts to happen again, then you'll see the floodgates open.
Yeah.
So Matt, let's wrap it up from here. Let's pick this up again next week. What else you got?
Last thing is, I'm just reminded by your shirt that I whooped you in the 5K, PM Health 5K. Just wanted to remind you that.
I don't remember that. I think that's a
hey, I will stand up and turn around, and then maybe you'll recognize me from the back.
That's just awful in so many ways that you would mention that. So,
all right, this was fun. Thanks, Brad.
Appreciate
Thanks for having me again.
All right, man. We'll talk soon. Take care.